In the fourth module of the course section dealing with consolidation workings, we will be shifting our attention to the treatment of intra-group transactions and the need to adjust and eliminate their effects from consolidated financial statements. Presenting information about the economic activities of the group as a single economic unit in consolidated financial statements requires adjustments for intra-group transactions to the amounts reported in the individual financial statements of the parent company and its subsidiaries. Intra-group transactions often result in the recognition of a profit or loss, which is also included in the book value of assets, typically items of inventory purchased from a group member at a markup. To the extent that such assets still remain in the books of a group entity at the end of the reporting period, the related profits will have to be eliminated from both the group results and asset values. It must be stressed that this elimination ought to be carried out in full, even if the transaction involves a subsidiary that is less than 100% owned by the parent entity. There are two distinct situations in which intra-group profits may in fact occur. The first is when goods are sold by one member of the group to another and these items are used as inventory, and the other when the goods received are used as non-current assets. Let us deal with the inventory situation first, where goods are sold by a wholly owned subsidiary to its parent, or by the parent to a wholly owned subsidiary, and some of those goods still remain in the receiving enterprise's inventory at the end of the year. The unrealized profit must be eliminated by means of the following double entry: a debit to consolidated retained earnings and a corresponding credit to consolidated inventory. Conversely, when the subsidiary that is a party to the transaction is only partly owned, the elimination of unrealized profit involves a credit to consolidated inventory and a debit to either consolidated retained earnings or a combination of group retained earnings and non-controlling interest. The first situation will occur when the sale was made by the parent entity to the subsidiary, and it is therefore the parent's retained earnings where the unrealized profit is held. On the other hand, the second situation will be associated with sales from the subsidiary to the parent, which produce profits in the retained earnings of the subsidiary. The post-acquisition retained earnings of the subsidiary are obviously apportioned between the group and non-controlling interest. Any elimination of unrealized profit will therefore be split in the same way. We may now move on to the situation in which the unrealized intra-group profit is generated upon the sale of a non-current asset. If this is the case, then its amount, the figure which needs to be eliminated, may be computed by comparing the carrying amount of the asset with the intra-group transfer and without it. That is, what the carrying amount would have been had the transfer never taken place. The amount of unrealized profit must then be eliminated from consolidated non-current assets and from the retained earnings of the group. If the item was sold by the parent, or from consolidated retained earnings and non-controlling interest if the item was sold by the subsidiary. Intra-group trading will also generate the need to eliminate and potentially reconcile receivables and payables balances coming from the individual financial statements of group members. If these accounts do not agree at the end of the reporting period, this will be due to items which are still in transit, typically cash or inventory. The required reconciliation is usually carried out by following through the transaction to its ultimate destination. So, if it is cash which is still in transit, the adjusting double entry is made in the books of the recipient, albeit only for the purposes of preparing consolidated financial statements, and involves a debit to cash and a credit to trade receivables. Conversely, if it is goods which are still in transit, then the relevant double entry is a debit to the recipient's inventory and a credit to trade payables. Once these consolidation adjustments have been made, the receivables and payables accounts of the seller and buyer may be offset and cancelled out, resulting in their complete removal from the consolidated statement of financial position.